All right, let's get straight to it. The market is giving us two completely different stories right now. You've got bullish sentiment indicators clashing with bearish macro data. So here's the plan for navigating the next 1 to 3 months.
So what is it? A rally or a correction? Honestly, the data's pointing in both directions. And in an environment this uncertain, making a prediction is a fool's game. What we need is a solid plan.
Okay, let's lay it out. On one hand, you have the bull case. It's a classic contrarian signal, right? We're seeing extreme fear, the VIX just spiked, that's often a buy signal. But then, you look at the bear case, and it's full of very real tangible risks. We're talking escalating geopolitical tensions and major domestic headwinds. The objective here isn't to pick a side, it's to build a plan that can handle either outcome.
All right, let's start with the case for a rally. We're going to look at the numbers, specifically what's happened in the past after we've seen this kind of extreme fear.
And the data here is pretty compelling. That recent one-day VIX surge, it was one of the biggest on record. Now, what happens after a spike like that? Well, historically, the median return for the S&P 500 1 month later is a positive 3%. That's a powerful, data-driven signal you just can't ignore.
And this isn't just an abstract idea. You've got people like Tom Lee over at Fundstrat saying this exact thing. He's looking at this fear-driven drop and calling it a gift, an opportunity. He's actually predicting a 200-point rally on the S&P by mid-November.
Okay, so that's the bull case. But it's not that simple, is it? Now let's look at the other side. That nice, clean, contrarian trade gets a whole lot messier when you factor in the wall of macro and micro risks we're facing.
And these aren't just vague worries. We have specific dates on the calendar. Look, US-China rhetoric is already tense. Then boom, November 1st, we have that potential tariff deadline. That's a hard catalyst. Right after that, the APEC conference. That could go either way. Either things calm down or they get a whole lot worse. These are what we call binary event risks.
And the list of headwinds just keeps going. The US-China conflict isn't just about tariffs anymore. It's moving into supply chains, specifically rare earth minerals. Back at home, you've got the potential for a government shutdown, all while we're sitting on a $2 trillion deficit. These are not small things. These are material risks to the market.
The risk isn't just at the macro level either. You got to look at the individual stocks, the market leaders, and they look stretched. Take a look at names like Broadcom, Oracle, AMD. They're all trading way above their 5-year average PE ratios. What does that mean? It means there's very little room for error, especially for that whole AI narrative. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
So with all these conflicting signals, trying to predict what's next is a waste of time. Preparation is what matters. So let's build a framework. We need a base case posture and a very clear plan for what to do if things go one way or the other.
All right, our base case posture has to reflect all this uncertainty. So we're not going all in, risk on, and we're not hiding in a bunker, risk off. It's about balance. We'll maintain some core long exposure, to catch any upside, but we're going to balance that with specific hedges for those geopolitical risks we talked about. And, crucially, we're holding a good amount of cash so we can be ready to act when an opportunity shows up.
Now, this is the most important part of the plan. Predefined triggers and actions, if-then statements. For example, a bold trigger might be the S&P 500 breaking above a key resistance level. If that happens, the plan says deploy cash, increase our long delta. On the flip side, a bear trigger could be the confirmation of those November 1st tariffs. If that happens, the plan says increase our hedges, reduce our long exposure. It's that simple. You plan the trade, and then you trade the plan.
Okay, so let's translate this entire framework into a few actionable, risk-defined ideas using options. And remember, these are just educational examples to show you how it works, not recommendations.
First up, an idea that directly tackles that geopolitical risk theme. We're looking at gold miners, specifically the GDX ETF. Why? Because they tend to do well when there's a lot of geopolitical uncertainty, which makes them a potentially effective hedge for the rest of your portfolio.
So how would we play this? A call-debit spread. The whole idea is that escalating tensions will be a tailwind for gold. We're looking at a short-term horizon, maybe 1 to 2 months, just to cover this main risk window. The great thing about a debit spread is that it clearly defines your max risk. It's just the premium you pay. It also gives you a positive delta hedge if the market takes a dive. And our exit? The thesis gets invalidated if we suddenly get some kind of diplomatic breakthrough.
Okay, idea number 2. This one targets that micro-risk we talked about earlier, those stretched valuations in big tech. Broadcom, ticker AVGO, is a perfect example. You have a high valuation combined with high implied volatility. That's an ideal setup for a premium selling strategy.
For this one, a bear call spread makes a lot of sense. The thesis is pretty straightforward. The stock looks overvalued, and it's probably not going to break out to new highs anytime soon. This structure lets us collect premium and profit from time decay, or if the stock drops. And importantly, it caps our risk if we're wrong and this rally just keeps on ripping. Our get-out signal? A clean break above our short strike.
All right, for the final idea, let's look at a risk-defined way to play that contrarian bull thesis we started with. If the market does rally like the data suggests it could, this structure lets us get in on the action, but it also caps our risk in case those macro headwinds win out. A bull call spread on the SPY is a really disciplined way to make this bet. The thesis lines up perfectly with the historical data, a short-term rally heading into mid-November. Using a spread keeps the cost of the trade low and, most importantly, defines our maximum loss right from the start. So if the bear case takes over and the market drops, we know exactly what our worst-case scenario is.
Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.